for February 2022. A lot of information we're going to cover today. Will not be as long as the meeting we had last month, since that was the first meeting of the quarter. Joining me on the call today is Mike Lanise and Trey Talley, the portfolio team of Fluent Financial. We're going to be spending quite a bit of time on what's going on in the marketplace, a rotation from growth and value. We have one small slide on COVID and where we think that the market's going to be going. So anyway, we'll go ahead and get this started. So first thing I want to share with you is we have got our video recordings that Mike does monthly back up and running, and so you guys can subscribe to it. We've got some new technology that's going to improve the client experience, so you can tap into that. Mike, we normally have these posted by Monday afternoon at the latest.
Yeah, Mitch, can I just add to that real quick?
Sure.
I don't know how technologically savvy all of you are, but when I searched in YouTube for Fluent Financial, we were not the first item to pop up. I had to scroll down slightly to find this page to subscribe to. So just don't be discouraged if you type it in and it doesn't take you right to where you're going. It is one of the choices.
Okay, fantastic, Mike. All right. So I'm going to go ahead and turn this over to Mike and Trey. This is kind of the overview slide.
Yeah, thanks everyone for joining on the call today. And so this is a quick preview of what the market has done since the Omicron variant occurred over Thanksgiving. Notice that it is down. The market is down, and that red block in the middle of this picture here, that's right at the beginning of the new year on January 5th. The Fed came out and announced that their minutes were released, and it showed that they are much more hawkish or aggressive, or they're going to become more aggressive when it comes to raising interest rates to try to control inflation. We thought inflation would be temporary, and now it looks like it's going to be a little more persistent. So they're going to have to make a little bit stronger moves toward keeping that in check. So just a highlight down below what we're going to cover today. We just have one quick slide on COVID. Last week we had a CPI print come out, and that's going to be the inflation gauge that is a big indicator for the Fed. We're going to talk about some geopolitical tensions. If anybody's been watching the news, they've seen what's going on between Russia and Ukraine. And we also have some consumer confidence numbers that came out late last week, as well as the news of that imminent invasion of Ukraine by Russia. And then we'll talk a little bit about how we are attacking 2022 with our portfolios and some tweaks that we have made.
Okay. All right. Again, I promised only one COVID slide. I'm sick and tired of talking about it. I know you guys are as well. This is the slide from last month where I basically said, here is the Omicron variant in South Africa. It started quickly and ended quickly. This is the U.S. slide as of yesterday. See the parallel? So I really think COVID will be behind us by the end of this month. And the State of the Union address, which is normally given by the president in January, was pushed back to May 1st. And hopefully Biden will be announcing the end of mask mandates and vaccine mandates, so there's not a bunch of truckers blocking our bridges and roadways as there has been in Canada. So I think we're hopefully at the end of this. Mike, why don't you talk about inflation now?
Okay, yeah. Mitch, can you guys hear me okay? Or do I sound muted to you? Mitch?
Yeah, you're a little quiet.
Okay, I'm not sure what's going on with my microphone, everyone, so I apologize. I will try to speak up here. But okay, so here are your inflation. So I said in the highlight reel last week on Thursday, inflation CPI number came out at 7.5%, which is the highest that it has been since 1982. For any of you who remember back then and the inflation that was going on. Now that's a year-over-year number. And while it's normal to see higher rates of inflation when you're coming out of a market dip as demand increases and the supply has trouble keeping up, we're facing that same situation now, and we expect it to dissipate over the near term here. We're already hearing talks of peak inflation, but what are current inflation expectations? That's that light blue line that you see on your chart below. And then your dark blue chart is what inflation looks like over a 5 to 10 year period. That's your longer term inflation. And the reason I wanted to highlight that is my third bullet point talks about economists like to focus on that long-term inflation number as it drives decisions that people make and could affect overall inflation. And I put that red light highlighted line there to just show you where we are historically with inflation all the way back to 1990. And I think you've seen that uptick, but I don't think these are inflationary panic levels, and we should soon see these inflation rates come down.
Yeah, one thing that I want to add, we've been talking about this inflation issue for many months, and a lot of people, including us, were saying it was transitory because of COVID, the supply chain interruption, and then things would be getting back to normal by this winter time. But the one part of inflation that is sticky that will not go back down is wage inflation. And with the record number of people leaving the workforce for retirement reasons, employers are having to pay people significantly more to keep people and to attract people. And that's really what's driving a lot of this inflation. So I think you are going to see higher inflation than we've had in the past. And why that's disconcerting, it's better than the alternative, which is deflation. And we talked about deflation. Well, we really talked much about deflation, but most of the economists and people that control monetary policy understand how to fight inflation. The tools for deflation are much more damaging long term. So we do think inflation will abate later on this year, especially when we get year-over-year comparison. And as the supply chain effect shows an oversupply, you're going to have excess inventories and then retailers cutting to kind of move the products off their shelves. So let's talk a little bit now about the University of Michigan Consumer Sentiment Survey. And what's really shocking is, and a lot of people on this call and a lot of people we talk with, people are not happy right now. And there's a lot of reasons for that. But this University of Michigan Sentiment Survey is the lowest it's been since the fourth quarter of 2011, when you had the government defaulted on their debt. The early 80s recession and 2008 recession are the only numbers over the past 40 years where it's been this low. So consumers are not happy. And if you think about it, the average consumer has to go to the grocery store, buy food to live. They have to put gas in their car and their truck. They're paying a heck of a lot more money for that. And a lot of the stores are out of the stuff that they want. And they turn on the TV, and our government's focused on climate change and other issues. And they don't seem to care about what it costs people to live. And there's a big disconnect between our politicians in the Beltway and the rest of the country. And you're seeing a lot of people around the world. You're seeing this in Canada now, that our politicians are so much out of touch, and it's just very unfortunate. And hopefully it gets better. So, and to that point, if you kind of look at, the politics does play a big role in this. And, Trump, people that are conservative don't understand the hatred of Trump by people on the left, and vice versa. People on the left don't understand why people on the right hate Hillary. But what's interesting is, if you look at how people feel things are going, this red line represents the Republicans, the blue line's the Democrat. And this is normally typical. Whoever's in the White House, that party can feel things are better. But if you look at what happened here after Biden got in office, when he got in office, that was kind of the high water mark, and his ratings have deteriorated. And the Republicans already felt horrible. I guess this uptick is they know the fall elections are coming. They may be able to get the House and the Senate. But, regardless of what party affiliation you subscribe to, I think both parties have done a really poor job in hearing the average American out there and what the key issues are. So geopolitical events, we're going to spend a little bit of time talking about this, But the major theme we want to get across, there's a lot of data on this chart, just focus on this red line. When Russia invaded the island of Crimea back in 14, the markets basically yawned. There wasn't really anything significant. And then you have, the Turkish plane, these other Russo-Georgian war. The markets really don't care. And there's been so much news and coverage over the past few weeks about Russia and Ukraine. It's a known, and markets have a tendency to respond much more violently when unknowns occur, a black swan event like 9/11. And kind of expanding upon that theme, this chart here, we're going back all the way to World War II, and we're showing how markets respond if there's a major geopolitical event. And the items highlighted in these boxes basically reflect what the markets did in the subsequent drawdown, what they did in one day, and what they did during the total drawdown period. Now, I think going back to World War II and Korea is too far, but if you look at 9/11 here in the Gulf War I with the Iraqis' invasion of Kuwait, these are going to be more relevant, and these are pretty significant invasions. You can see that how many days it was at the bottom, how many days it took to recover. So you're looking at about 6 months here. Then you had these minor geopolitical events here, and there really wasn't much of a movement in the market at all, and the recovery happened pretty quickly. So we don't think that if Russia does go ahead and invade Ukraine, it's going to have a big negative impact on the market, and the market has a lot of this priced in. The China and Taiwan is the other geopolitical event. And if you look at this survey of Taiwan people, over half the people want to keep things the status quo. They recognize they're kind of a stepchild of China. They're kind of a country without a home, so to speak. Only about 31% want independence, and 7.2% want some kind of unification with China. There's a phrase I learned this week called elite capture. Elite capture. And that's the Chinese Communist Party buying off either corporate or political leaders so they will respond favorably to the Chinese Communist Party. So I kind of call this orange slice the elite capture of Taiwan. And the next slide we'll talk about a little bit how we think that's going to happen. But we think military action would not be in the best interest for China or obviously Taiwan. So what we really think is going to happen, this is the same graph, they're going to probably wait to the 2024 elections and try to make inroads into Taiwan as kind of what they've done with Hong Kong. Because the Taiwanese people know if they sign any kind of formal alliance with the U.S., where the U.S. is kind of on the dotted line to protect them, that's going to probably create a potential hot war scenario. So we don't think the Taiwan scenario will be as big of an issue. So Mike, why don't you talk about investing during volatile markets?
Thanks, Mitch. I wanted to mention two things. One, we have two people that have called into this and not using their computers. Can you please mute your telephones? Because we're getting a little bit of background feedback. That would be great. And second, on the upper right-hand corner of your screen, you should see a little cartoon word bubble. If anybody has any questions during this presentation, please click on that box and you can type your questions in there. Okay, so what all this leads to, we talk about the rising rates being a threat, and we talk about geopolitical events. So investing in volatile markets, we feel that big down days present really nice buying opportunities. And what you see over here on the left-hand side are the worst single down days in the markets and how the markets performed 1 year later. And on the 1 year later side, I see one negative number, and that's during the Great Financial Crisis. It took us about 36 months, I think, 34 months, something like that, to come out of that Great Financial Crisis. And then if you look over on the right-hand side, you'll see the event and the market pullback for the event. The Great Financial Crisis is in there as well, down 56.8%. Then 12 months later, the market's up 68.6% from that bottom point. So it definitely pays to stay calm and stay invested. The markets just took a big hit. We're down about 10% now through the first 7 weeks of the year, and I think the markets are just getting a little bit spooked by a couple of unknowns. But I think that we are in a pretty good position right now, and I'd like to talk about what we are doing with our portfolios and where we want to be. So this is a slide Trey put together on growth stocks versus value stocks. And when you think of growth stocks, you're talking about stocks that are growing at significantly above average rates compared to the rest of the market. And those are going to be your technology and communication type sectors. Discretionary is also one of those sectors. When you say discretionary, think of something like a Peloton that is a technology discretion. And then you have value stocks that people tend to run to. That value stocks tend to do really well when you're coming out of a recession and they're already beat up. They have a lot of value in them and they have low PEs and they do really well. We were pretty heavy in value last year, and that's going to be your energy, industrials, financials. We were a little light on financials, but the growth stocks tend to outperform in decelerating economic environments. And I put that little red circle on the chart there because you're hearing a lot of things in these earnings announcements by these companies as they are giving guidance, talking about peak earnings and peak growth. So I feel like we may be coming to this top point here. So we wanted to make a little bit of a shift in the portfolios. So this green line shows the number of companies in the S&P 500 since 1999 that are having top line growth greater than 15%. And so what you're finding is less and less companies are meeting that qualification. And so there's a demand for these growth companies. And when you have more money pouring into fewer stocks, it tends to disproportionately make those stocks move higher, have better returns. So that's the environment that we find ourselves in right now. So the shift that we recently made, this year we are looking at a move from last year. Last year we had about a 40% value to 15% growth blend in our equity portfolio, and okay, that doesn't equal 100%. Okay, so the difference of that, the other 45% means stocks that had a blend of both growth and value in them. So now in 2022, we are moving more to a 15% value blend and taking more of a 30% growth approach because of where we think we are in that market cycle. And when we did this, it increased risk slightly for us. Risk is measured by standard deviations, and we show that on the chart here, going from 18.07 to 22.6. But our risk-adjusted returns really take off. There's two different types that we like to measure here. Sharpe ratio is going to be the investment performance compared to the rate of return of a risk-free rate. Think of a risk-free rate as a 10-year U.S. Treasury bond. And why risk-adjusted returns are so important. I like to use the example of someone says, well, I made a 4% return last year, and someone else says, well, I made a 20% return last year. Okay, well, the 4% guy was in a U.S. Treasury bond, while the 20% person was in an internet startup company. Who had the better returns? Well, I would argue that internet companies blow up all the time, especially during the dot-com level era. So that was a lot higher level of risk to only get a 20% return, whereas a U.S. Treasury getting 4% is basically taking no risk. So we like to think of things on how much return we're getting for the risk that we're taking. And so we saw a really big jump in our risk-adjusted returns when we made this shift over more to growth. Okay, so growth versus value during Fed rate hike cycles, and we're about to go into a Fed rate hike cycle. They're saying they're going to increase rates in March. It's argued whether it's somewhere between 25 and 75 basis points. We think 50 basis points or 0.5% is expected. And if you look down here, you see ever since the great financial crisis, you see growth outperforming value 75% of the time. And we show some other examples of growth outperforming value, even in a rising rate environment. And one of the discussions that Mitch, Trey, and I have been having is, okay, well, why is that? What is so different now that growth is, people aren't running scared into value stocks during a growth environment? And the big factor for that is prior to the great financial crisis of '08, the Federal Reserve typically only used interest rates to either slow down or increase activity in the economy. Now, all of a sudden, we have quantitative easing. And what that is the Federal Reserve actively purchasing bonds and injecting cash into the markets, or quantitative tightening, where they are removing that cash from the marketplace. And right now, the Fed finds themselves in a place where they need to remove that stimulus from the marketplace, as well as raise rates to cool off the current economy. How much they need to do is what's in question, and how fast they're going to do it and how that's going to affect the market is what all this volatility is happening right now that we are seeing.
Yeah, something I wanted to add is that when the Fed considers a rate hike, one rate hike is considered 0.25% or 25 basis points. If they do a 50 basis point rate hike, even though they say it's one rate hike, it's actually two, because it's 225 rate hikes. So if you hear 50 basis point or 0.50 rate hike, that's actually two rate hikes.
So getting out of the rate, take rate hike cycle away from it and just look at the economy overall since the dot-com time frame here. We're going back to 1999. You have growth beating value 61% of the time. But if you look at since the great financial crisis, growth is beating value 88% of the time. And again, you have that Federal Reserve using additional tools that they had not used in the past. And so growth we think that growth is where we want to be in this economy.
Yeah. And a lot of people like to look at information on graphs, Mike, and that's what these next two slides are going to show.
Yeah, so purple being growth and orange being value. What are considered growth stocks versus value stocks in the S&P 500. And you see that big spike back in 2000 for growth. That's the dot-com bubble that we did see pop. And once that popped, you see growth and value churning along. And then they start to separate a little bit after 2009. And then let's see what they did since 2010.
Yeah.
So since 2010, you see growth more than double the return of what value has done. And that's part of our growing technology, getting away from more of an industrial producing country in the 20th century to more of a technology based service type country. Okay, so who gets punished more during financial crises? And this here shows 5 of these different crises and which stocks got punished the most, growth or value. I would argue that in this recent 10% downturn, growth was hit harder than value. I have a chart for that. But if you look over time, the great financial crisis, value was hit, had a 63% pullback versus only a 50% pullback in growth. Our point is that this is not an unsafe place to be during market turmoil or market crises events.
And I think the other thing to remember is even though the Fed's pulling the punch bowl back for quantitative easing, if we have another recessionary period, they're sure as heck going to do it again because they've used that tool in the toolbox. And again, as we've kind of shown today, you're better off to be in more of a growth-oriented stock than a value because of that new dynamic.
Okay, so this purple line is a relationship between growth and value stocks. So when you see the purple line going up, that means growth stocks are outperforming. And when you see the purple line going down, value is outperforming. So we recently did a rebalance. January 3rd, we wanted to wait till the new year. We had a lot of gains last year. And we did the portfolio reconstruction January 3rd and January 5th. Fed minutes came out showing how hawkish the Fed was and possibly raising rates more aggressively. And all boats went out with the tide. And so what do you do in that situation? Okay, we were about 3 weeks premature from a pretty nice repositioning. And so what we decided to do was on the 21st of January, we thought we were getting close to a bottom level, a safety level there. We went ahead and rebalanced the portfolio. Some portfolio managers rebalance quarterly, semi-annually, only when market events occur. We typically rebalance when market events occur. The reason you would rebalance is because company A, you won at 3%, is now at 3.5%. Company B, you won at 3%, is now at 2.5%. Your rebalance takes company A and puts them back at 3% and then backfills company B. Well, we did that rebalance on January 1st to kind of reposition and get our risk levels where we want them to be, even though we did a reconstitution of the portfolio 3 weeks earlier. So again, we were a little premature, but we feel like the rebalance has us where we want to be going into 2022.
Yeah, and what we want to point out to people, this is specifically for the value and opportunity or V&O portfolio, and then ADVP, which is 1/2 V&O portfolio and 1/2 Advantage. It did not impact the other portfolios. So this is only 2 of our portfolios have been impacted with this change.
And then through the first 7 weeks, now this isn't, tomorrow will end the first 7 weeks. So this is through today. And you see that that the value is down about 3%, whereas growth is down about 12.5%. So that's almost a 10% difference between the two. And again, we did that rebalance back there on the 21st, just to kind of reassess, get us where we want to be moving forward. I think this experts are estimating these 5 to 7 rate hikes. I disagree with that. What I'm seeing is once they start raising rates, if we truly are seeing some peak growth levels and peak earnings, we're going to start to slow down this economy. I can't see the Fed in a slowing economy going from 75 basis points to 1% or 1% to 1.25%. Whenever that starts showing up, I feel like they're going to be a little more reactionary and a little more timid to be raising rates in the face of a slowing economy like that. We're going to have these supply chains unwinding, and then all of a sudden we're going to have a glut in the economy. I just think things are going to slow down a lot quicker. I think a worst case scenario would be rates going up to 1.5, 1.75%. I just don't feel that is going to happen. Yeah. So I do think we're really well positioned.
Yeah, and I think to add to what Mike was saying, this is a off-year election year, and the Democrats control all major political positions. They don't want the economy crashing as we go into the election, so they'll probably put as much pressure as they can on the Fed not to raise rates too much. On a slide we showed last month, we basically show the market does not feel the Fed will raise rates as highly as they say they're going to, and it's probably for the reasons Mike articulated. And so we do think we're going to see some abating of inflation. The rates may not go up as much. The bond market year to date is down about 4%, to put this in context. So there hasn't been a lot of safe places to put money. And if you have money in cash at a 7% annualized inflation rate, even though you don't see the number changing on your bank statement, the purchasing power when you go to the grocery store or put gas in your car, you definitely feel it. So the last slide we're going to end with is showing the performance of our option-heavy portfolios, and this is when we show each month. And we promise on these portfolios to generate this amount of yield on an annual basis, and this is the amount of income you would generate on $1 million portfolio. This is the trailing 12 months of what we actually have done. And we've made some changes to these portfolios using more weekly options, and we're going to talk more about that in the coming months to show you how that's working. But it's had a very positive impact on these portfolios because of that. But that's going to be a webinar for another day. But the initial results have been fairly positive.
Mitch, I just want to give a quick correction. You said we promised these amounts. These are our target amounts every month. The 9.6, 4.8, and 12%. That's what we shoot for every month.
Yeah. I just like to keep Mike on the hot seat a little bit. So, yeah.
So just to recap for everybody, again, if you have questions, upper corner, just to recap, the Fed is spooking the market with being a little more aggressive on the rate hikes. We have some geopolitical tensions going on right now, and you're seeing the markets take a hit these first 7 weeks of the year as this uncertainty filters its way in. Today, markets were down pretty significantly today. Dow was down almost 1.8%. S&P was down over 2%, and the NASDAQ was down almost 2.9%. And that happened kind of late in the day. The market just started falling out as the Russians are building field hospitals and things outside of Ukraine, and really moving those forces up. So although people are saying, oh, no, it's de-escalating, signs are showing that it is escalating and that an invasion is even that much closer. I don't see anything on the news right now saying anything has happened since this call, but that's what spooked the markets today, everyone.
So I'm going to stop the